Back, everyone. How's everybody feeling? Feeling good, energized, ready to go? We had a great start this morning, and so I am very excited about what's in store for the rest of the day. Now, let me introduce to you another one of our FHLB Des Moines board members, Chris Grimm. Thank you.
Thank you, Artis. As Artis said, my name is Chris Grimm, and I'm the president and CEO of a small community bank called Bank in Burlington, Iowa. And I've served on the board now about 10 years, and I've been on just about I have been on every committee over that 10-year period. And so I'm very passionate about the Federal Home Loan Bank. I think it's a great cooperative and a fantastic system, and I've enjoyed serving on the board. I'm excited to introduce Minnesota's own Neel Kashkari as our next speaker. Neel Kashkari has been president and chief executive officer of the Federal Reserve Bank of Minneapolis since January 1 of 2016. In this role, he serves on the Federal Open Market Committee and brings the 9th Federal Reserve District's perspective to monetary policy discussions in Washington, D.C. In addition to his responsibility as monetary policymaker, Kashkari oversees all of the bank's operation and was instrumental in establishing Minnesota's Fed Opportunity and Inclusion Growth Institute, whose mission is to improve the economic well-being of all Americans. Please welcome President Neel Kashkari and Lindsey Piegza.
Okay, that's fine.
Well, good morning, everyone, and welcome. Let me start by thanking our esteemed guest, Minneapolis Fed President Neel Kashkari, and of course, welcoming all of our audience members, to today's fireside chat. Now, along with the organizers of this week's fantastic event, we put together a number of questions to ask Neel, broaching a number of different subjects that I think everyone in this room is going to be very concerned about. Topics that we're concerned about as consumers, as investors, and of course, as members of the FHLB. Now, I think the only disappointment that we're going to face is the limited amount of time that we have with Neel. So let's go ahead and get started. We have a lot to talk about. And I want to start off with talking about the domestic economy and really getting a broad sense of what you expect in terms of growth going forward. So what are your expectations for growth in the second half of the year? Or maybe better said, how pronounced will the economy's reduced rate of growth be as we head into the end of the year and beyond into 2020?
Thanks. Big question, and I'll start there, but thanks everybody for having me. It's great to be with you. You know, this is the big question that we're wrestling with right now because the economy is sending mixed signals. On one hand, the good news is the vast majority of Americans who want to work have jobs, and wages are slowly picking up, so families generally have more money in their pockets, and they're spending that money on their families. You know, consumption is about 70% of the U.S. economy, so if people have jobs and they're earning a little more money, that's good for the U.S. economy. But that's a backward-looking indicator. Looking forward, somebody's trying to communicate to us through the flashing lights. It's like a sci-fi movie here communicating to us. I just saw Independence Day, you know, they're flashing the lights to try to communicate with the alien ship. This is the same thing. So the consumers have generally been strong, but at the same time, businesses appear to be nervous, and they're pulling back on investment, and they're pulling back on hiring. So while the job market is still growing, and people are still finding new jobs, the rate of job growth has slowed quite substantially from where it was a couple years ago. So that's a nervous indicator going forward. At the same time, if you look around the world, the global economy appears to be slowing. Europe has slowed, Germany is slowing, China is slowing. If the rest of the world is slowing, we're not going to be immune to that. Trade is important. It doesn't drive our economy, but it is important. And if the rest of the world slows, we're going to feel that. And so right now, I think the signals are mixed. My base case scenario is still one of growth. I'm not forecasting a recession, but I think the risks to the downside have increased quite a bit in the last 6 months.
Now you talk about the mixed signals that we're seeing in the data. What about some of the signals that we're seeing from the marketplace? Because the yield curve seems to be sending warning signs of a more severe slowdown and a possible recession. Now, obviously, historically, an inverted yield curve has been a very good predictor of recession. So I guess I have two questions here. Would you agree with that line of thinking in terms of the yield having predictive power? And are you concerned about its prediction of a recession, even if you don't read in the data that recession is coming?
Yes, I am. I take the yield curve signal seriously. Predicting recessions is fiendishly difficult. If we were good at predicting a recession, we would all do things to try to avoid the recession. And yet you and I know recessions happen. So that means we're bad at predicting recessions. The best indicator we have, as Lindsey said, is this inverted yield curve. Basically, in the last 50 years, when the yield curve is inverted, a recession is followed within a year or two. And by the way, every time that happens, there are economists who say, oh, this time is different. Don't worry about it. And right now, there are economists who are saying, this time is different. Don't worry about it. I do take it seriously. I'm not putting all of my weight just on the yield curve, but I think at a minimum, it's giving us information about the stance of monetary policy. So what is the yield curve? It's the rate that the government borrows from investors, short-term versus long-term. Typically, it slopes up. The Federal Reserve basically controls the front end of the yield curve. Because we move the federal funds rate up, short-term interest rates move with us. We have much less direct control over the long end of the curve. So right now, the federal funds rate is slightly above the 10-year Treasury rate. So we control that. We're controlling the front end of that curve. So that, to me, tells me that monetary policy is pretty close to neutral or may even be slightly contractionary. So whether the yield curve is a literal predictor or cause of recessions, I don't know. But at a minimum, it's giving us feedback on the stance of monetary policy. And I'm asking the question, should monetary policy be at neutral? Should we potentially be slightly contractionary? I would say no. I think monetary policy should be somewhat accommodative in light of the risk that we're seeing.
Now, we've mentioned recession several times, which is loosely defined as 2 quarters of negative growth. But even if we don't meet the technical definition of recession going into the end of the year and going into 2020, is there a fear of falling into a non-accelerating economic state? And this is something we were talking about just before we came up here. Meaning, is the bigger risk to the US that we fall into a perpetually slow state of growth? Not necessarily negative, but a slow state. So sort of a Japan-style environment, if you will, during the lost decade.
I think it is a risk. I think what we're seeing now, there was some enthusiasm around the last presidential election. Markets responded pretty positively after the election. And then there was a lot of excitement about the tax cut that got passed, that would supercharge US growth. I think some of that enthusiasm you're seeing in the data is now waning, and it appears that the US economy is returning back to its earlier slow growth trajectory. Now, are we going to end up being, so that would imply that the tax cut didn't really boost the long-term growth potential of the US economy, that it was more of a Keynesian stimulus effect. We knew it would at least do that. The hope was that it would also lead to higher structural growth going forward. I think so far that doesn't appear to be evident in the data, but it's still somewhat early. Now, are we going to be Japan? That's not my base case scenario because Japan has we have a demographics challenge. We're having fewer kids than prior generations. So our population is growing more slowly, and population growth is one of the sources of economic growth. Well, Japan has a much worse demographics problem than we have. So all else being equal, Japan is actually growing per worker just as fast as we are. They're actually a pretty productive economy on a per worker basis, but they have a big demographics problem. So I think for us, the question is going to be, are our demographics going to become as bad as Japan's? I don't think so, but I also think that immigration is a key differentiator. And historically, immigration has been a big driver of US economic growth. And it can be, again, going forward. Japan, it's much harder for them. Just politically, culturally, they're much less receptive to immigrants. Now, obviously, we have our own political challenges here. But I actually think immigration is going to be a really important source of economic growth for America going forward.
You mentioned the tax cuts having a very limited or temporary impact. Do you think that was more a reflection of the policy or the timing of the policy? Had we seen that same type of tax cut, but earlier in the economic cycle, would that have had a longer, more profound impact?
It's unclear to me. I mean, I'm inclined to think that if a tax cut has more of a Keynesian effect, which is just a stimulus effect versus a structural effect, the timing is less. I'm not sure. I don't know that. You just look how our business is responding. It seems like with the tax cut, you're hearing lots of anecdotes of businesses buying back stock. Does not appear to be leading to a lot of new investment, and certainly investment appears to be falling right now. So if it had happened earlier, would that have changed their decision? It's hard for me to see that.
Let's talk about inflation expectations for a second. Headline inflation has struggled to meet the committee's 2% objective for quite a long time, not just in the more recent years, but for the better part of the past decade, if you will. What are your expectations for inflation through the end of the year and into 2020? And I would add on there, what role do tariffs play in terms of your inflation expectations?
My own inflation expectations are we're going to continue undershooting our 2% target for the foreseeable future. Right, you're exactly right. We basically missed our target on the downside for essentially 10 years, averaging around 1.6 or 1.7%. Even if you strip out volatile food and energy, even if you look at core inflation, it's still around 1.6 or 1.7% for the last 5 or 10 years. I don't see any evidence that we're getting much closer to achieving our target. So that's why I've been arguing against the interest rate increases that we've implemented over the last several years, since I've been at the Fed for the last 3.5 years, because I didn't see evidence that inflationary pressures were building and going to push us above our 2% target. And I believe that there was still slack in the labor market. And so I was simply saying, why are we tapping the brakes if we're undershooting our inflation target? In terms of tariffs, this is complicated. On one hand, you would think that tariffs would be inflationary, at least a one-time resetting of the price level. If all of a sudden there's now a 25% tariff on something you're buying from abroad, your price goes up. We can model that. That's a one-time repricing. But that by itself doesn't lead to higher inflation going forward. At the same time, if the tariffs and trade war are really spooking business, and businesses are nervous and they're pulling back because they're just worried about the uncertainty, that can be disinflationary. And so that shock to confidence can actually lead to lower inflation and less investment going forward. And that's the much bigger concern. And when I travel around our region and I hear from a lot of businesses, large and small, a lot of them are expressing nervousness about the tariffs, about the trade war, about the global uncertainty. And anecdotally, they seem to be pulling back, but it's also showing up in the data.
Is there also a concern on the part of businesses being able to pass that cost increase on to consumers? So are businesses trying to absorb that cost increase of the tariffs directly and maybe passing that on to the consumer indirectly through reduced wages or hiring, et cetera?
We hear those stories too, but I also say to them, this is a conversation I have all the time with businesses. They say, we can't find workers. And I say, well, have you tried paying more? No. Well, maybe you ought to try paying more. Supply and demand in any market, you got to pay more if you want more of something. They say, well, we can't pass our costs on to our consumers, so we can't pay more. Well, if every one of your competitors faces the same cost pressures, then you can pass those costs on to your consumers, right? It can't be that's the one thing about tariffs or about the allegedly tight labor market. If you're facing these challenges, so are all of your competitors. And so therefore, your customers won't be able to just pick this other producer that doesn't have the same cost pressures because it applies to everyone equally. So I hear those stories. I'm not that sympathetic with them.
Well, let's actually stay on the idea of wage inflation or wage growth. If you look at the most basic definition of unemployment, we're at a near 50-year low. But if there's such a minimal amount of slack or tightness, as you talk about in the labor market with a sub 4% unemployment rate, why aren't we seeing that wage pressure? Or why are we seeing such disappointing or certainly lagging wage pressures over the past couple of years?
I think that headline unemployment rate, which is 3.5%, is painting a misleading picture of the actual stance of the labor market. That rate only includes people who are actively looking for a job. A remarkable thing happened. During the Great Recession, the unemployment rate went up to 10%, and a lot of people were out of work for a long period of time. And the economic consensus was, they're lost, they're gone forever, never to return to the labor market. By the way, it turns out that was totally wrong. It's taken 10 years for the labor market to recover and slowly bring people back in. So the government, the US government, the Bureau of Labor, does surveys every month of the labor market. And they do a phone survey, and they call you up and they say, do you have a job? No. Are you looking for a job? No. Well, a lot of people who say, no, I'm not even looking for a job, the next month, take a job. So it turns out there are other people in the labor force or potentially in the labor force, but they're just not counted. We don't have a good way of counting them. And what we're seeing anecdotally is as the labor market has gotten tighter and as businesses have had to work harder to find workers and wages have slowly picked up, people have come back in. They saw their brother or sister get a job, or they saw their neighbor get a job, and they say, you know what, I want to get that job. And then they've come back in. So my explanation for why wage growth has been so modest is that there's been more slack in the labor market than we appreciated. There may yet still be more slack in the labor market, and this is undeniably good news for the U.S. economy. It means the U.S. economy can continue to grow without leading to high inflation. It means more Americans can get jobs, and that's good news for everybody.
How does technology play into that conversation in terms of replacing workers, in some cases permanently, and reducing the demand for particular types of workers, particularly in the service sector, manufacturing, mining, et cetera? How does that play into the wage discussion?
I think it's a complication, which is kind of hard to untangle. One of the conundrums, we were talking about this before we came up here, over the last decade is that productivity growth has been quite low in the US relative to history. One of the explanations is that businesses didn't have to invest in automation and technology because they could just go find an endless supply of cheap labor and just put more people on the job rather than putting on machines or robots. So now you see businesses say, well, if I have to pay more to get this worker, then I will just invest in a machine and invest in automation. So that also would imply we don't see inflationary pressures. I mean, if they have this outlet of turning to automation, that also is not necessarily inflationary. That could mean the US economy has more productivity, more room to run. So I think all of this is happening, and I think all of that is positive.
Now, we often talk about the economy as we have been as a whole. But before we move on to monetary policy, which I think we're all excited to get to, let's talk a little bit about local growth for a moment. Growth in our local communities, if you will. Do you see an impact of bank consolidation on community growth?
I do. When I travel around my district that I represent, we represent the Minneapolis Fed, is Minnesota, North and South Dakota, Montana, Upper Peninsula, Michigan, and Northwestern Wisconsin. It's very rural. So when I travel around, this is a challenge in many, many rural communities as the banking sector continues to consolidate. The fact of the matter is, it's very difficult for a big national bank to know enough about a local market to get comfortable to make loans to a homeowner or somebody who wants to buy a home or a small business in a local community. And that's where the community banks are uniquely positioned to provide that value. And it's really important to their own local economy. So I do think consolidation is having a challenge or presenting challenges in these communities. And there are a lot, rural America is under many, many different pressure points. You've got consolidation of banks, you've got access to broadband, access to healthcare, consolidation of the farms, et cetera. I mean, these are long-term trends that unfortunately I don't see an easy way to reverse. I will say I visited some communities that have really good partnerships between their local businesses and their local government leaders to try to invest and make the communities attractive for their young people to come back. A lot of young people go away to college, but then they may want to come back to have their families back in the town that they grew up in. So what can they do to make the town more inviting for them to want to come back? We've seen them try to support businesses to encourage entrepreneurship. And you've seen some communities really embrace immigration and say, our towns are thinning out as our young people leave, and what can we do? Some towns have really gotten aggressive about embracing immigration, and their schools are growing, their communities are growing, their economies are growing because of it. But they're not easy answers.
You touched on schools. Let's talk about education for a second. You recently wrote an op-ed with Justice Alan Page about the educational disparities that we're seeing, specifically in Minnesota. If you would, talk to us a little bit about the background of that op-ed and the gap as you see it. I think also we'd be interested to know the implications of that gap and maybe some possible solutions to that gap.
Well, I came to Minnesota 3.5, almost 4 years ago, and one of the things, Minnesota is a remarkable state with a lot of strengths, diverse economy, on average, a well-educated workforce, a lot of Fortune 500 companies. It has a lot going for it. I was really surprised to discover these extraordinary education disparities, not just between white Minnesotans and African Americans or other Minnesotans of color, but between well-to-do Minnesotans and low-income Minnesotans. I mean, these are some of the biggest gaps in the country, and people have been working for 20 years to try to close them, and the truth is, if we're being honest with each other, big fat zero. We've made zero progress in closing these gaps. And it's a statewide issue. It's not just a Twin Cities issue. It's true across rural Minnesota too. So why do we care at the Federal Reserve? Congress assigned us our dual mandate: stable prices and maximum employment. The single best determinant of the job market and success in the job market is education. And so if we really want to achieve maximum employment, if we want Minnesota's economy to be competitive and vibrant for the next 50 years, we need to educate all of our people. And it doesn't mean everyone has to go to a four-year college, but everybody needs to graduate high school. People need opportunities, whether it's a technical school or a four-year college. So I think it's enormously important to the economy. Justice Page, who I understand was here yesterday, and I'm sorry that I missed his talk, he comes at this through the lens of justice. I come at this through the lens of the economy. And the funny thing is we come at it differently, but we end up in the same place. We got to address these gaps. And so he and I are partnering to look at a wide range of solutions to bring real scale to addressing this. And so I don't want to front run what Justice Page and I are working on together, but I could not imagine a better person to partner with to try to bring the state forward to really attack these gaps, and I think he's an extraordinary leader.
And for the audience, just so that you're aware, the op-ed is available on your app under the materials if you haven't yet read it. But staying with education just for a second longer, when we talk about the gap in education, that translates out into the labor market. And is that something that we're seeing in terms of the slack in the labor market, that skills mismatch? Businesses looking for specific skills and the applicants maybe not having those skills?
You hear that a lot, and I think there's some truth to it, but you're also seeing businesses forced to respond. So I'll give you an example. Businesses are used to saying, I need a machinist who knows how to run this CNC machine. So they put out a job posting that have 20 people lined up with that exact same skill. Today, they maybe can't find that. So you know what some are doing? I'll train you. That's great news. Mm-hmm. It is great news if businesses are now out front saying, I will train you to do the job I need you to do. I need you to show up at 8 o'clock, 5 days a week, and work a 40-hour week or a 50-hour week, but I'll invest in you. So, or another thing is that businesses used to say, and by the way, this is true for us at the Minneapolis Fed, for this certain job, you must have a master's degree, or you must have a bachelor's degree. Now we're asking ourselves, really? Must you have a master's degree to do this job? Or could you have experience in another field and be skilled? So I think all of us are now looking at, do we really have to have, why do employers do this? Why do employers say, you must have a master's degree for this job? They do it to narrow the resume pool. Because historically, they'd get 100 resumes. They're like, I don't have time to look at 100 resumes. So let's say there's a master's cutoff. Great, now I only have 30 resumes I have to look at. Now let me focus on the 30 resumes. So these are a lot of artificial barriers that when there's tremendous slack in the labor market, we have the luxury of imposing. And now businesses are having to walk those back, and I think that's really good news.
Could it be a bit of a double-edged sword, however, with the heightened level of labor mobility? Do businesses have the incentive to offer on-the-job training if they don't necessarily have a commitment from that employee that they'll stick around after that training?
Well, it's funny. You hear about this a lot, people changing jobs a lot, but if you look at the national statistics, mobility has really decreased in the U.S. over the last 50 years. And this is a debate that I'm having with my economists all the time. Is it mobility that's decreased or people are choosing to move less? So it's a very complicated issue. But the bottom line is businesses don't have a choice. If they want to staff themselves, they need to go the extra mile. So you're seeing businesses say, you know what? I used to do a drug test for this certain job. I don't need to do that. I'm not going to do the drug test anymore. Or I used to do a criminal background check for a certain job. I don't need to do that anymore. They're lowering the barriers to bring more people back into the labor force, and I think that's good news.
So I think we have a pretty good sense now of where you see the economy headed and what you expect from the economy, despite all the different variables and changing factors in today's environment. But let's switch over now to policy directives and what we can expect from the Fed in terms of guiding the economy back on track. Now, first off, let's talk about the September rate decision. Widely supported by Fed members, although not unanimous by any means. And the committee seemed pretty divided going forward. If we look at the September dot plot, it shows that the majority of Fed officials don't anticipate any further action. But the markets right now are pricing in an October rate cut at about 80%, depending on the different indices that you look at. With that disconnect in mind, talk to us a little bit about forward guidance of the Fed's views. Is forward guidance beneficial? And how should we interpret the Fed's forward guidance for policy going forward as we await the October meeting and beyond?
Well, that's a very complicated question. So the dot plot is each individual participant in the FOMC. So the voting and the non-voting members. I'm a non-voting member. I go to every meeting. I'm going to be a voting member again in January. Every participant, so 12 Reserve Bank presidents and 5 governors, submits their own individual forecast or projection of what we think the economy will do under what we individually think is optimal monetary policy. So that is not a consensus forecast of the committee. It's a collection of 17 individual projections at a point in time. And as data comes in, people are constantly revising their own projections of what is optimal for the economy. I'll tell you, relative to September, I think the data has come in since the last meeting generally softer. Generally, it's been a little bit more downside than I would have expected at the September meeting. So, we'll see. I don't want to prejudge what the committee will do, but I think we are all trying to be data dependent. And as the data moves, I think our outlooks tend to adjust.
So you see the dot plot as a tool of assistance in terms of giving the market an understanding of where policymakers are in the current point of time, not a prediction, not a commitment of policy going forward.
Certainly not a commitment. I actually think, the dot plot, forward guidance is a very complicated thing. So how do we affect the economy? Generally, we move the federal funds rate up and down, and that's an overnight interest rate. Well, why does anybody care about an overnight interest rate? You don't care. I don't care about an overnight interest rate because it can have some effect on long rates. And when a homeowner wants to go buy a house, the 10-year treasury is actually really important because mortgages are often priced relative to the 10-year treasury. So if the 10-year treasury goes down, generally speaking, mortgage rates are going down, homes become more affordable, people buy more homes. So we move the federal funds rate up and down to try to move long rates somewhat. Another way we try to move long rates is quantitative easing by buying long-term assets to try to drive long-term rates down. And third, forward guidance. So if the Fed came out and said, hypothetically, if the Fed came out and said, we commit to a 0 federal funds rate for the next 10 years, the 10-year treasury would likely fall dramatically. The yield on it would likely fall dramatically. So forward guidance can be a very powerful tool to affect expectations for monetary policy and to affect long-term rates and therefore to affect the economy. But I think the forward guidance that we've been issuing in the last several years has been muddled. I mean, basically, I look at the dot plot over the last 5 or 6 years has been hawkish. It's been forecasting rate increases when it turned out the economy needed fewer rate increases. So while I thought the original purpose of the dot plot was to provide accommodation, I actually think the dot plot has been contractionary because it's been providing contractionary forward guidance, and I don't think that that was intended.
Well, the dot plot is certainly exciting, and as we talked about yesterday, half the people in this room admitted to having that on their refrigerators at home. So certainly something that we pay attention to. But let's talk about the October FOMC meeting. Now, I realize that you can't necessarily reveal your position or predict policy movement, but let's just assume that we do see a third-round rate cut in October. Would a further reduction of rates signal a validation or an indication of a slowing economy? And if interpreted as such, could that decision actually have a negative impact on confidence relative to, or I should say overshadowing, than a lower cost of borrowing to businesses and consumers?
Well, that's a big hypothetical, and hypothetical on a hypothetical. I mean, I guess it's always possible that if the Fed were to cut rates, that people may get scared by that. They may, wow, the Fed must know something that's really scary that's causing them to cut rates. So I'm not going to dismiss that possibility, but I think if we saw economic data trending south and we thought the right thing to do is to provide more support to the economy, I think that's what we should do. Because I think the idea that we shouldn't, if we took the alternative view and said, no, even though the data supports a cut, but we're not going to cut because it might scare people, I don't see how that would be optimal for the economy. But I take your point. I mean, sometimes these things may not land quite the way you think they will.
What about even from a nominal perspective? Given that rates are already historically low, would an additional 25 or even 50 basis points really add additional momentum to the economy in terms of consumption and investment?
I think on the margin it would. I mean, this goes back to a fundamental point about what interest rate is neutral. What interest rate neither stimulates nor restrains the economy. We can't measure it exactly. We have to try to estimate it. But we're pretty confident that it has fallen over the last 30 or 40 years. And we don't set it. This is set by broader macroeconomic forces like demographics and productivity and investment. And so what are the central banks doing? If the neutral rate has done this over the last 30 years, we're moving interest rates up and down around that neutral rate to try to slow down the economy or stimulate the economy, but we don't set neutral. And so we believe the neutral rate is quite low today on a real level, in terms of real, maybe around 0. Some people think it's even slightly negative today. So we're trying to adjust monetary policy relative to our assessment of neutral. And even though on a nominal sense and an absolute sense, rates are low relative to history, I don't think they're low relative to neutral.
You talked about the different policy metrics that the Fed has in terms of controlling rates. Aside from lowering rates directly, the Fed's balance sheet has now come back into focus. Last week at the NABE conference, the National Association of Business Economists, Chairman Powell announced that the Fed is preparing to resume purchases of Treasury securities limited to T-bills. The decision, he said, though, was meant to address a technical issue in the funding market and not intended to be seen as a jump-starting of asset purchases used during the financial crisis, specifically QE. So 2 questions here. One, how do you read the recent volatility in the funds market? Was it because of a combination of corporate tax payments and the settlement of Treasury debt, or was it a reflection of the fact that monetary policy has become restrictive on a number of different levels, including the reduced size of the Fed's balance sheet? So that's one. And then 2, why isn't this QE? Because in 2009, Bernanke said that any policy action that increases bank reserves, regardless of the maturity, regardless of the size, is considered QE. So why isn't this then QE?
Well, I would say, and I've got great admiration for former Chair Bernanke, I think we know a lot more about QE now than we did in 2008 or 2009 when we first started. And so what is the Fed doing? So I talked to you earlier about we did QE to try to push long rates down. So if the Fed goes out and buys mortgage-backed securities or 10-year treasuries, you're going to directly have some influence on long rates. Well, what are we doing now? What has the committee announced? We're going to use bank reserves, we're going to create reserves, and we're going to buy T-bills. So we're going to be exchanging one very short-term asset, risk-free, for another very short-term risk-free asset. There's nothing about that that affects the long rate. And so that's why this is not QE. This is literally about making sure the plumbing of the financial system works. So why did it happen? We knew as the Fed was shrinking its balance sheet, we would be draining reserves from the financial system. We also knew that because of new regulations and a bunch of other reasons, banks were demanding more reserves just to meet their own liquidity needs. So at some point, those two would kind of cross. And we weren't exactly sure when that would happen. We were surveying banks, asking how many reserves do you think you need just to meet your own funding needs. And it happened, I think, a little bit sooner than we thought and then banks thought. And so now all the Fed is doing is saying, okay, we're going to provide more reserves to the system to make sure banks can meet their short-term liquidity needs. And that's why it's really a technical plumbing issue. It's not about monetary policy itself.
Okay. Aside from the announcement of bills being purchased, is there room, or how much room is there to expand the Fed's balance sheet if the economy were to slow further? Now, we peaked at $4.5 trillion last time. Could we get to 5, 6, 7 trillion this time around? And would such a move, in your opinion, be helpful in controlling longer-term rates? Because you did mention that T-bill purchases has nothing to do with long-term rates. Yes. So would this be helpful?
I think so, if we needed to. People have asked, if there were another recession, what would you do? You don't have that much room in the federal funds rate. That's true. I think the first thing we would do would cut the federal funds rate. And then I do think we would turn to forward guidance and quantitative easing. And I see no reason that if we needed to, sure, QE could do there could be another very large QE focused on driving down long-term rates. And I do think it would have some beneficial effect. I mean, even if the neutral rate were much higher than it is today, and even if we had, typically in a recession, the Federal Reserve will cut interest rates by about 4 or 5 percentage points, 400 or 500 basis points. Even if we had that much room in the federal funds rate, it's not a perfect response to a recession. It's not like a shock hits us, we go from 5% to 0, and then there's no recession. There's still economic costs of whatever the shock was that hit the economy. And so monetary policy, even through our traditional tools, is not a perfect response to an economic downturn. It does a lot of good, but there still is pain that's going to be felt. And so I think quantitative easing can be a powerful tool if we need to use it again.
In terms of costs, what are some of the unintended consequences that we could face by maybe growing the Fed's balance sheet back to 4.5 or 5, 6, 7 trillion?
I'm not sure. when quantitative, because I said it was new in 2009 when it was first done, people said, oh my gosh, this is going to lead to runaway inflation. That didn't happen. It's been 10 years now, 12 years now, it didn't happen. And in fact, as we said earlier, inflation's been low, it hasn't been high. So that risk doesn't appear to be front and center. They said, oh my gosh, it's going to destroy the dollar. That didn't happen. So the big hyperbolic risk factors that people talked about have totally been wrong. Now, is it impossible that they could happen next time? It's not impossible. But that's why I think that we have more confidence that we could use these tools if we needed to in a future downturn. And of course, we'll keep our eyes open for potential risks. But at least the big risk that people feared the first time around didn't materialize.
So the fear of slower growth is not isolated to the US. In fact, there's rising risks or rising fears of the risk of a global recession that have sent global yields, as we kind of talked about here, lower, and in some cases further into negative territory. Are you, or do you get the sense the Fed is concerned about this scenario? Or how serious would the global perpetuation of negative interest rates be? And then how would the Federal Reserve respond to something like that?
Well, I think the negative yields that you're seeing around the world, and I'm not talking about the policy rates, I'm actually talking about government bonds, longer-term government bonds that have, a big chunk of them have negative yields around the world. That's not being driven by central banks. That's being driven by broad macroeconomic forces. Again, it's this notion of the neutral rate has been declining around the world, and central banks are having to respond to where that neutral rate is. We don't set the neutral rate. So is it possible it could come here? It's possible. Again, I think our demographics are better than Europe and better than Japan, and that's part of it. But you can never say never. I don't think that we at the Fed would be inclined. I don't think we would desire to try to move the federal funds rate negative as a policy tool. But I also don't want to say, hey, it's impossible. We would never ever go there. But let's talk for a second about why are neutral rates falling. So what is the neutral rate? It is the interest rate that balances savings and investment in the global economy. We believe that as societies age, people tend to save more. So you have more savings. And then the question is, where's the demand for that investment capital? In the US economy in the last decade, the biggest demand for investment capital came from the oil fields. North Dakota, Oklahoma, Texas, a lot of capital going into fracking and tapping these new reserves. Where are the other big demands for capital? Facebook and Twitter and Uber, these don't require any capital. So where are the big capital destinations? So what could drive the neutral rate back up? Is there some new technology that comes along that people say, wow, we can do this massive investment, it's a positive return? If that were to happen, if that were to reveal itself, then I think you could see the neutral rate boost back up because demand for investment capital would go back up. So this fundamental imbalance between savings and investment is ultimately what's driving the neutral rate down, and that's forcing central banks to have to respond to that, rather than central banks saying, we're just going to keep rates low.
Now, you touched on it, but I just want to go back to it,
Sure.
the idea of negative rates
Sure.
here in the US. Do you see any sort of scenario where the Fed would be willing to engage in negative interest rates? Talk to us about what that would look like.
I mean, I think in my own mind, I'm only speaking for myself, in my own mind, if there was a recession, the first thing we'd do would be to lower the federal funds rate back down to what we call the effective lower bound, which is near zero, but not quite zero. Then I think we would turn to things like forward guidance and quantitative easing. If the scenario were bad enough, is it conceivable that we would then try to move the federal funds rate in negative territory? I mean, it's possible. I haven't heard much appetite for that expressed publicly from my colleagues, so I don't think it's something that we would be excited to do. It would be a pretty bad economic scenario, but I also don't want to say never, it's impossible, because obviously some other central banks have done it, and it hasn't led to terrible, hasn't had terrible repercussions, I think, in the economies that have done it.
Well, the Great Recession was obviously a very difficult economic time, and the Fed didn't choose to go negative then. So you're suggesting that it would have to be some sort of scenario worse than the Great Recession to really make that a possible.
Potentially, or something else. Markets and the economy are constantly changing. So if there was some other development in the markets that said, hey, you can't use QE or you can't use forward guidance or something else is going on, I can't envision what that is right now. So I don't think it's a likely scenario, but again, I don't want to say never.
Absolutely. Well, with other central banks, as you mentioned, around the world actively engaged in QE and pushing interest rates negative in some cases, do other central banks, or are you concerned that other central banks have enough dry powder to help stave off recessions in their respective economies?
I mean, I think it's tough all around the world. I mean, I do think they have room. You know, Japan, as an example, we haven't talked about fiscal policy. You know, Japan has roughly twice as much debt to GDP as we have, and their government's borrowing costs are even lower than our borrowing costs are. So it seems like one of the things we're learning is that advanced economies have more debt capacity than we realized. Now, that doesn't mean, in my mind, you can just have unlimited spending programs forever, but if the US or Germany or Japan had some major new investment program that they wanted to make. You know, I'll give you an example. I mean, this would be too small to move the needle in the US economy, but I think it's worth doing. If the US Congress said, you know what, we're just going to go wire America for broadband. We could afford to do that tomorrow. The US government could fund that tomorrow. And I think there are many other projects like that the US could go fund itself. So I think monetary policy is going to be a key part of the response to any downturn. But I also think fiscal policy will ultimately have to play a role.
So let's talk about some lessons learned from the financial crisis of 2008. If you would indulge us for a moment and dig into your past, tell us a little bit about your experience serving as Assistant Secretary of the Treasury and the actions that you took specifically around the decisions to make the TARP program or implement the TARP program.
Well, there's a lot there. I joined Treasury in 2006. And when I joined Treasury, Secretary Paulson said to me and a few others, hey, we're due for some kind of crisis. So we worked with a little team at the SEC and the Fed to brainstorm on what the crisis could be. We looked at a bunch of different scenarios. None of us looked at home prices nationally declining. So we were looking and we totally missed it. And then the crisis started to flare up and you started to see housing correct. And we were always late. Like we were and this is like self-reflection on us and mistakes we made. We didn't want to believe that the crisis was as bad as it ended up being, or we couldn't envision it being as bad as it was, and we kept hoping that markets could deal with it on their own. So we were reluctant interveners, and at every turn, it just got worse, and it just got worse, and then we did a little more, and it just got worse. And then finally, we had to go to Congress. Chairman Bernanke and Secretary Paulson, with President Bush's approval, made the decision to go to Congress and ask for the unprecedented authority, $700 billion, to go stabilize the banking system. And ultimately, we bailed out the banks. We invested government capital in the banks to make sure that they were safe. We didn't know if it was going to work. I mean, in our worst moments, I didn't think we'd get $1 back of the $700 billion, and that we'd have to go back to Congress and ask for more. And in our worst moments, we thought the banking system was literally collapsing. It was collapsing, and that we would have to find a way to put it back together again, with thousands of banks all around the country potentially going bankrupt. So it was terrifying, and sitting where we are now, it's almost a miraculous recovery to where it looked like in the middle of that crisis. The fact that the US economy, it's been slow growth, but it's been growing for 10 years. The labor market has now recovered to where it was before the crisis. I mean, it's, thank God the worst didn't happen.
So would you say TARP overall was successful?
Absolutely. I mean, it was incredibly controversial. Hank Paulson, my old boss, likes to joke that 60% of Americans were against torture, waterboarding, et cetera. 90% were against the TARP, And so when I would have to go testify before Congress, they were memorable experiences, shall we say.
And before we move on, what role do you see the FHLB playing during the crisis? Obviously, we're speaking in front of an FHLB audience, so I think this is very apropos too.
Well, I think it's, one is obviously housing is enormously important to the country. And so housing finance, supporting housing finance was a key part of what we were doing. So TARP was one big thing on the banks, but then we also had Treasury's action to take over Fannie and Freddie and to make sure that they could play a role. And obviously Fannie and Freddie are a huge part of the housing market. The home loan banks are also a big part of the housing market. And so I think supporting housing was really important for the US economy. If banks couldn't get funding to make mortgage loans, the crisis would have been even worse. But then it begs the question, got to make sure the home loan banks are safe and got to make sure that they're not themselves a systemic risk. And so I think the attention on all government-sponsored enterprises and making sure that the risk controls are appropriate around them, that taxpayers know what they're getting, and that they're not undue risk being taken by the home loan banks. I also think that that's important for the country going forward.
And speaking of housing, let's touch on affordable housing for a second. Up until recently, we know that home prices were trending at a very robust pace, 2-3 times wage growth. And despite low rates, with such elevated prices still on a nominal level, the prospect of home ownership for many Americans still remains unattainable. So what do you view as the root cause of the nation's decreased amount of affordable housing?
It's complicated. We're spending a lot of time at the Minneapolis Fed unraveling this onion, and it is a complicated onion that we're unraveling. Part of it is, so you got to ask the question, people have jobs, they're making decent money, why aren't builders coming in to take advantage of them as customers and say, I'll build an apartment you can afford, or I'll build a house you can afford to buy, or a condo or something? Part of it is regulation. A lot of new regulations have come in all around the country that are creating barriers. A great example is in California, they passed a law that every new house must have solar panels. Well, when you increase the price of a house by $10,000 with good intentions, you are directly affecting the affordability for low-income families. Every good idea you have to add a mandatory feature is making that a little more out of reach for a low-income family. And so we need to be honest with each other about that. That's part of it. Another part of it is we are demanding bigger homes. Our analysis says that half of the decline in affordability is driven by the fact that we're building bigger homes and we're demanding bigger homes. By the way, that's not a public policy problem. So a lot of people romantically view the 1970s and say, oh my gosh, my parents had it so much easier than I did. You know, it was just my dad working and we could afford to buy a house. Now both husband and wife have to work to afford to buy a house. Yeah, but you're buying twice as much house. So that's not a public policy problem. And so we need to be really clear as we try to unravel this, where are the public policy problems and what are not public policy problems. And if people just want to live in a bigger house, okay, that's fine. You're going to have to pay for it.
Well, even when we take out the luxury homes and the large McMansions on the market, when we hear that it could take the average American 30, 40 years in some cases to save for a down payment on a median-priced home in some of the country's major cities, this sounds to me very reminiscent of the market, of the housing market crisis, with prices very much out of line in terms of income availability. So are you seeing at this point any signs or trends that could lead you to believe that we're making the same mistakes, leading us down the same path?
I think, you know, we have a team at the Board of Governors, a financial stability team, that looks at different asset markets and looks at valuations and trying to look for signs of frothiness. I haven't seen the research that says we're seeing it in residential housing. There have been signs of pricing pressures in commercial real estate, as maybe more flashing yellow, not quite flashing red. Some of my colleagues have been talking about WeWork as, you know, a sign of irrational exuberance there. So, I mean, I think there are pockets where there's some signs of frothiness, but one of the things that's tough, you hear about this term reaching for yield. You know, we're in a low interest rate environment, so investors are reaching for yield, and that's dangerous. It's very hard to tell the difference between reaching for yield and repricing your assets at a lower neutral interest rate environment. So if investors realize we're in a low rate environment for the foreseeable future because of broad macroeconomic forces, and you take the same cash flows and you discount them at a lower neutral rate, you're going to get a higher price. So one person's reaching for yield is another person's repricing at a lower neutral rate environment, and sometimes it can be hard to tell the difference. So our eyes are open, we're looking all around for signs of excesses. You know, you're never sure.
So it doesn't sound like you see an asset bubble brewing at this point. Do you see a bubble anywhere in the economy at this point?
I mean, some of these private valuations of some of these tech, you know, unicorns, obviously they seem like they're completely out of touch with reality, but I don't care. I mean, I don't care if WeWork's investors lose money. What do I care? Why do you care? You shouldn't, right? This is the private market working. When the tech bubble burst, you know, in 1996, Alan Greenspan declared we have a rational exuberance in the stock market. And then the stock market climbed the next 4 years, and then the tech bubble burst, and there was a pretty modest recession that followed that. If the Federal Reserve in 1996 started raising interest rates to prevent the stock market from climbing for the next 4 years, that likely would have been much more costly to the economy than the recession that actually followed when the tech bubble burst. So what if tech investors lost money in 2001? That's the market. And so I'm not seeing signs of things that imply a financial stability risk, and that's where I think we should be most focused.
Any concerns about the overall level of corporate debt?
Again, corporate debt levels are higher. I'm really focused on the big banks. So what is a channel by which these adjustments can lead to crisis? it's the big banks, if the big banks get into trouble again. I've been very outspoken that I think the biggest banks in America need a lot more capital than they have today. But I also admit they do have more capital than they had in 2006. So the banking sector is stronger than it was in 2006. It's not strong enough based on our analysis. It needs to be stronger, but I think we are better off than we were back in 2006.
So you talk about capital. What is the right level of capital? And how might these prescribed levels, as you've talked about it in many of your commentaries, vary among different types of financial institutions?
So our analysis says we picked a $250 billion cutoff for the biggest banks. There are a dozen or so banks bigger than that they should have risk-weighted capital in the 20s. And today they're in the low teens. So substantially higher than where they are today. And this is running costs and benefits. The benefits to society of faster growth versus the costs of having financial crises. And you can never take the risk to zero. And trying to take the risk of a crisis to zero would be very costly. So you got to find the right balance. Our analysis, and a lot of other people's analysis, says much higher levels of capital would be optimal for society. I would have you note that small banks in America today generally have much higher capitalization levels than the giant banks. That makes no sense. Small banks are not going to bring down the US economy. The big banks could. So just looking at the risk, the big banks should be more capitalized than the small banks. But we literally have the reverse scenario today. In my mind, it doesn't make any sense.
Now, before we open up to audience questions, just one more question on that point. Are larger institutions still too big to fail?
Absolutely. If they were to run into trouble, they're like a nuclear reactor. And they don't like it when I say this, okay? They're like a nuclear reactor. If a nuclear reactor melts down, like Fukushima, governments will spend anything to try to stabilize it because the costs to the rest of us are so profound. Well, if the giant banks in America get into trouble, taxpayers are going to have to step in. The only way to prevent this is to make sure that they have enough of their own capital, enough of their own skin in the game, that they can absorb their own losses. And again, you can never say never. You can never build a dam so high that it'll protect from every flood, a 1,000-year flood. You could always have something bigger. But our analysis says the right trade-off between costs and benefits is a lot higher capital for the biggest banks.
And with that, I think we're going to open it up now to the audience for some questions. There's some microphones floating around if you have any questions for Neel Kashkari.
And please just do me a favor and introduce yourself. Just tell us who you are when you ask the question. And maybe we should have said this at the beginning. We're live streaming this since I don't like to give talks where it seems like I'm sharing secrets. So I try to live stream everything that I do. So just know.
Hello.
Hello.
My name is Keela. I'm from Bremer Bank in St. Paul. I'm just wondering, in regards to work, what does an average week look like for you? And in regards to being the president of the Minneapolis Fed, what keeps you up at night the most?
Well, my job is pretty diverse, which I really like. So we have about 1,000 employees or so at the bank. So part of my job is just spend managing the bank, and there's always management stuff that's coming up, as you all know. That's probably about a third of my time. About a third of my time is spent with our economists doing deep policy analysis on housing or monetary policy or the labor market, which I really enjoy. I really love public policy. And about a third of my time is doing things like this, coming out and sharing our views with the public or talking to the press. I travel around our region a lot just to make sure I can learn firsthand what's happening in South Dakota or Montana, Minnesota, et cetera. And so my weeks are very varied. And I go to DC every 6 weeks. I probably go to DC on average once a month. So I'm traveling a fair bit too. So it's a pretty mixed thing, but that's fun for me.
And what keeps you up at night?
Oh, I'm sorry. I knew there was a second part.
Aside from your 8-month-old baby?
Yeah, exactly. We have an 8-month-old baby at home, so she keeps me up at night. And she sleeps with us. We read all the books, and we're not doing any of that, unfortunately. But it's working. Whatever we're doing is working, so that's good. It's all the things that you don't see. Where are the risks brewing? Is it this asset market or is it this? The problem with financial crises, it's always where you're not looking. And that's just the nature of them. So we're so focused right here. What is it over here that we should be focused on? That's always in the back of my mind. And that's why I try to talk to a wide range of people. And our economists are really brilliant at the Minneapolis Fed. They're always pushing me. We're always having robust conversations to try to take the blinders off. But you know, it's hard.
Is this on?
Yes, sir.
Hi, my name is Mike Mason. I'm actually from just outside of your area, Wyoming. You spoke about how at this point we have larger banks less well capitalized than smaller banks. What solutions do you think might be out there in terms of incentivizing a reversal of that status?
Oh, the only solution is the government. I mean, it's got to happen from legislation or regulators saying this needs to change. Because the big banks, this is about their stock price. Every proposal to raise capital requirements, the big banks fight tooth and nail because it's one-for-one a reduction in their stock price, and they'll never do it on their own. And so it's got to come from regulators or legislators.
Hello, my name is Stephen Leafgreen. I'm President and CEO of Western Vista in Cheyenne, Wyoming. Take us back, and thank you for talking about your time at the Treasury and that time. What were the 2 top items that you learned during that time, and what do you think you would have done differently?
I learned that public policy really matters. You know, I always say to folks, if you want to help 1,000 people, donate to a charity. It's really important, and you can do a lot of good. You want to help 1 million people or 10 million people, you can only do that through public policy. And it really, I mean, we were doing our best for the country, but look at, even though the Fed did extraordinary things in the financial crisis, Congress did extraordinary things, $700 billion TARP, Treasury did extraordinary things, and Congress had the fiscal stimulus, we still had 10% unemployment. Millions of people were still dramatically affected by the financial crisis, some only now recovering. There were a lot of people, you know, bought homes they couldn't afford. There were a lot of people who bought homes they could afford, then they lost their job, and then they lost their house. And so the costs to society were absolutely profound. And so I think for me, public policy really matters. The downside costs of recessions are very painful to families, to working families. The less income you have, the less education you have, the more devastating these things are. I think that's it. And so that's probably what's motivated me as I keep looking at the data for signs of, are we really at maximum employment? Why are we raising interest rates? Why do we want to tap the brakes? If we can let the economy continue to strengthen and bring a few more workers in, that's great news for them and for all of us. I think that's burned into me.
Looking back at the crisis, do you think there was more the Fed could have done or should have done to mitigate the impact, the negative impacts of the recession?
Yeah, I think with the benefit of hindsight now, as I said, all these terrible things that quantitative easing were supposed to do didn't happen. So with the benefit of hindsight now, I think quantitative easing could have been earlier, bigger, more aggressive. I think forward guidance could have been earlier, a stronger commitment. I think those things could have been more powerful. But again, that's not a criticism. We know a lot more today than we knew 10 years ago.
What about on the side of the federal government? Is there more that we should have seen from fiscal policy?
I mean, again, with the benefit of hindsight, sure. I mean, fiscal policy could have done more. You know, there's a lot of conversation about shovel-ready projects and how long things take. You know, I remember when the stimulus was being debated, the concern was these projects are going to take too long and the recovery is already going to be over by the time these shovels go in the ground. Turned out the recovery took 10 years. And so even if the projects weren't shovel-ready, they probably would have done some good. And so, again, with the benefit of hindsight, all these things become clear.
Do we have some more questions out there?
Hi there.
Hi.
Laura Beebe. I'm with Farm Bureau of Iowa. I'm in West Des Moines, Iowa. So there's a crowd on Twitter that is talking about how the Fed needs to be doing more in the repo markets. And we've had, I don't know, the numbers are $75 billion a day on repo. So are we doing enough? What do you think about that, given that we want to do quantitative easing? Recessions are painful.
Well, I don't think thanks for your question. I don't think what's going on in the repo market is a reflection of the stance of monetary policy. I do think it is about, the committee decides this is the monetary policy we want to have, and then we need to transmit that decision into the markets and into the economy through the money markets, essentially. So the decision of what policy stance we want to have, that hasn't changed. But the committee said we need to do more to make sure the transmission of that policy is effectively pushed through the markets. And I think the committee is doing the right thing. I think the New York Fed is doing the right thing. And we know how to do this. I mean, this is something that was done daily almost at the New York Fed before the financial crisis, making sure that our policy transmission is effective. So I think the Federal Reserve is doing the right things. I think we're going to do enough. And if it turns out we need to do more, we'll do more. So, I mean, there's a crowd on Twitter for everything. And, you know, take it with a pound of salt. And they're gonna be reacting to the fact that I just said that, and they're gonna be insulted that I just said that. Hi.
Good morning. My name is Josh Kiefer. I'm with Country Club Bank. I office here. Our bank's in Kansas City. First of all, I think I speak for a lot of people in here. We appreciate the candidness that you bring in a lot of your responses.
Thank you.
Now that dovetails into my question on transparency. Do you think there's a point where there's too much? Of course, during the crisis, it was important to be very transparent to the economy. However, if you sit in front of a Bloomberg and watch the Treasury market when Powell speaks after a decision, the volatility that it creates in the Treasury and the stock market from one sentence to another is incredible. And I guess the question is, do you think there's too much, can be too much transparency? How do you feel about what you all are doing now? Should it be toned down a little bit as it relates to the volatility it creates in the marketplace?
Well, people raise that a lot. I generally think, I try not to make predictions about what we're going to do at the next meeting or beyond, because I think that that's, number one, I don't know. And number two, I think that that can be unsettling if 17 people are making their own predictions. But you mentioned, the chairman's press conferences. I think it's a good thing. The chairman has decided now, after every FOMC meeting, to have a press conference where he can better explain the decision so that people understand what went into it. When the Fed chairman speaks, whether it's Jay Powell or Janet Yellen or Ben Bernanke, markets pay attention to it. And so I don't hear a lot of people saying that they should be hearing less from the Fed chairman. I think they say they should be hearing less from me and more from the Fed chairman. And so I take your point, but I don't think I'm the one moving. I don't think there's any way to avoid it. When the Fed chairman speaks, his voice is so important, it's going to move markets. And I don't think we should hear less from him. I think he's doing the right thing.
Kevin Pernick, Bank Plus in Estherville, Iowa. We talked a little bit, you briefly touched on the trade issues, and we look at the trade issues and they're creating some headwinds for our economy. If we had a sudden reversal in that and a deal was struck and things changed, does that bring inflationary pressure behind it? I mean, are we building up to some inflationary pressure there?
I suppose it's conceivable. I mean, if the trade uncertainties all of a sudden lifted, and let's say Brexit had a smooth resolution and China and the US had a smooth resolution and markets were open and now there was this big positive boost to confidence and a lot of investment coming, then you would think in that environment, the neutral rate would probably rise because there'd be more demand for investment capital. So you would then expect to see interest rates rise. Would that lead to some burst of inflation? We're not seeing it. But the thing is this, we have the total ability to raise interest rates as much as we need to keep a lid on inflation. The thing that's much harder for us is to boost inflation. So our tools are one-sided in terms of the power that they have. And so, that would be a high-class problem if that were to happen.
Any other questions? Well, before we let you go, we haven't addressed the autonomy of the Fed. There has been some harsh language directed at the Fed more recently. How do you think that impacts the Fed's decisions, and what does the Fed do, either on the individual level or collectively, to push back against that to make sure that the market knows that monetary policy is not influenced by political communications?
Yeah. Well, by the way, and to the gentleman's question about too much Fed communication, I actually think us talking about this and getting asked this question and explaining the rationale for our decisions, I actually think that helps. So one of the things that's wonderful about the Fed, that I love working at the Fed, is the thing that unites all of our staff, whether you work in law enforcement or you're an economist or you work in HR, is a spirit of public service. That's why people choose to join the Fed. And we all believe in our hearts that we need to make decisions based on data and evidence, not based on politics. It's woven into the DNA. So the louder the heat gets turned up politically, the more we all hug data and hug analysis, and we just hug it tighter and tighter and tighter. And that's how we get through it. You know, if we heard politicians saying, do this, and then we did it just because they wanted us to, we wouldn't be doing our jobs. If we did the opposite, just because they were asking us to do something, we also wouldn't be doing our jobs. So the only way through this fog is to do what we think is the right thing for the economy based on the dual mandate goals that Congress has given us. And that's what I believe all of my colleagues and I are trying to do, and that's absolutely what I believe our chairman, Jerome Powell, is leading us to do, and I think it's the right thing. So, and that's why I actually think opportunities like this are great, because I can explain to you my rationale for my own interest rate recommendations, and hopefully you're getting a sense that, wow, it's not politics that are driving Neel, it's the data.
So the Fed will remain data dependent, act as appropriate, and we certainly look forward to seeing how the Fed will act at the upcoming October FOMC meeting. Well, thank you very much, Neel, for joining us here today. Thank you, everyone, for participating.
Thank you very much.